Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo, and on today's episode, we're going to be talking about self-insurance. I've had several people reach out to me recently. A couple were clients, and a couple of people were actually prospective clients, and they brought up this idea of self-insurance. And there's a lot of Reddit threads out there and a lot of other things that they wanted to talk about in terms of the true relevance of possibly self-insurance. And so today's episode, we're going to go through some hypothetical examples of maybe where that actually could make sense to do, and some other examples where it may not make sense to do. So without further ado, let's dive right in. So real quick, self-insurance. This is where, as opposed to purchasing an insurance policy, you actually just say, if that event occurs, I'm just going to either fund the damage out of my own pocket or my own balance sheet, or the thought of that someone brought up to me is they're going to go get a loan to fund that and then pay back the loan. So let's walk through an example of how this could possibly work. First thing, so let's just talk about auto insurance. Your auto insurance has several parts to it. Two main parts around auto insurance is a coverage for your car. So if someone steals it or breaks into it, right? You've got car insurance for the car. And then there's the liability insurance. The liability insurance is if you're in a car accident and you're at fault, and the liability insurance is covering the other party, right? So let's talk about the auto insurance standpoint from the car itself, right? So you have to have liability insurance in, I think, all states, if I'm not mistaken. But you don't actually have to have what they call comprehensive coverage on your car, meaning if the car was stolen, then the insurance company is not going to replace it. Now, there comes some ramifications of that if you don't have insurance. If you have insurance, then they will hopefully send you a check to replace the value of the car at the time it was stolen. If you don't have insurance, then maybe if you've got a bunch of cash sitting on the side or assets sitting on the side, maybe you go use that and you purchase another car. Now, the issue is if you have a loan on the car that was stolen, you still owe the money back on the loan and you're buying another car, which if that's what you want to do, that's great. And in the grand scheme of things, let's just say you bought a $50,000 car. $50,000 most of the time is not going to make or break your financial world. So in that instance, self-insurance could make sense depending on what your balance sheet looks like. If you don't have any assets or savings set up, that may not be the best decision. But let's take it to another level now. Let's talk about the liability side, right? So a common thing that I bring up to many clients is getting an umbrella insurance policy. An umbrella insurance policy is, so imagine you're in a car accident, you're at fault, and the person you hit has some medical damage. And maybe that person also has to miss work for several years, or maybe can't go back to work full time. Like who knows what the incident occurs. Do you think that they might sue you for any loss of income because they can't go to work or go to work to the same capacity that they were in? The answer to that question is yeah, they might sue you, right? We're in America. So what could they sue you for? Well, let's just say we're talking the person that you hit was a med student. They're 30 years old and their income, at the time, let's just say it's $100,000. Okay. So if they can't go back to work, they can sue you for quite a bit amount. They might be able to sue you for 30 times that income because they've got probably 30 years of work left. And so maybe they can sue you for 30 times $100,000. That's $3 million. So you have $3 million on your balance sheet to cover that. And that's not including medical damage or anything else. If you've got $3 million, that might make sense to do. But that's in that one instance. What if you hit someone that makes a lot more money and they sue you for $10 million or $20 million? Who knows what that lawsuit might be? Then they can, in some states, if you don't have it on your balance sheet, they can actually sue you and come after your income. Like in Washington State, you can actually get sued. And even though you're not worth anything from an asset standpoint, they can actually come after some of your income. So how do you want to handle that? Do you want to have that risk on your balance sheet? So my rule of thumb when we're talking about self-insurance versus insuring is if it's something that where it's a huge number where they can come after your income or it is financially devastating, that is something that you most likely want to insure. Whereas if it's something that's smaller, $50,000, $100,000 or less or something like that, depending on what your balance sheet looks like, then maybe that is something you could self-insure. I'm not saying you should, maybe you could self-insure. But the bigger ones, yeah, you definitely want to insure. Here's the exact example that I went over with a client of mine. So I'm going to bring up my screen here. So for those of you listening in the car, again, just a heads up for you, we do have a YouTube channel. The visual side I'm going to put up here. I'm going to explain as well as what I'm doing here. We're looking at a balance sheet, and we're looking at a balance sheet of a couple that makes $400,000 a year, and their total assets right now are 2.1, a little bit over $2.1 million. Okay. And the conversation that this person brought up was disability insurance, and one of them didn't have disability insurance. Well, disability insurance covers you if you were to get sick or injured and you couldn't go to work. So if this person's making, let's just say $200,000 a year, let's just split they make half the money in the household. So they make $200,000 a year. That's $200,000 that may not come in the door then. So should you insure that or self-insure that? Well, let's start thinking about this. $200,000 a year, they've got a couple years of self-insurance. But if this person's in their 40s and they plan to work for another 10 to 15 years, well, 10 years is $2 million, and that's not with any increases in pay. They're wiped out. So that's problem number one. Problem number two is they could go get a loan, but if you get a loan and you don't have a job, how are you offsetting paying back the loan and the interest rates, right? Now, their thought around self-insuring is saving money. Let's just call it what it is. Okay, so let's talk about saving money and what the true cost could possibly be. So when we look at insuring, what we're going to do is, let's just say the policy would have cost $3,000 a year. And let's just say this person decided to save that money. Let's just say they invested it. Let's just say they got a 7% rate of return for the next 10 years. So for the next 10 years, if they saved that money, that they would have saved $44,000. If they invested it, got that 7% rate of return. That's 44 grand that they would have had if they never were disabled. Is 44 grand worth the savings, knowing that the event itself could cost $200,000 just in 1 year alone? Let's take it out a further step. Take it out 20 years. Well, 20 years, that's $131,000. Is $131,000 of savings really worth self-insuring when we're talking about such a huge number? Remember, we're talking about this person's income may not be coming in the door anymore. That's a huge number. So again, going back to my philosophy around self-insuring versus insuring, if we're talking about your income being protected, that's probably worth protecting and protecting fully, because that's how you're living your life today and living tomorrow. Self-insuring is ensuring, if you don't want to buy the insurance on your iPhone, or you don't want to buy the insurance on the car, like I mentioned, make sure your balance sheet can actually handle that. But those are the items to self-insure if you choose to. So I wanted to share this with you. This comes up several times a year, and it really is stemmed, I think, oftentimes from, and it's not always a cost issue where the person's trying to be cheap necessarily. It's more of just their thought is, well, if that doesn't happen, that's a lot more money I could have kept on the balance sheet. And they're right. The chances of it happening is slim. But if it did happen, and you got to say that there's a chance that you could become disabled. If it did happen, it ruins you financially, as well as maybe even ruins the family, because that you never know where that goes. So that's the reason that I'm saying to insure versus self-insure in that instance. I hope that today's episode was valuable. Look, we started this podcast to have you think differently about your money and be more efficient with your money. So this isn't insurance is the only play. This is a conversation of understanding what it is you're protecting, which has a different way of looking at things. I hope this episode is valuable for you. Head over to beerandmoney.net, and at the top of the page is a contact us section there where you can either ask questions on today's topic, possibly, or any other questions you might have. Is a great spot to reach out to us. As always, cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7263486.1, expiration date November 2026.